Hi, I'm Millie Gormley, Certified Financial Planner Professional in Ontario, Canada, with your 2023 financial planning and year-end tax tips. Taxes are one of the average Canadian's biggest expenses. I know, right? But there are things you can do to save taxes, and here's another tip for you. If you have investments in non-registered accounts, and that means anything that doesn't have a label on it, like RRSP or RESP or RRIF or TFSA or RDSP, you might want to see if you can take advantage of tax loss selling. This involves selling investments with losses at year end to offset capital gains that you've made elsewhere in your portfolio. So, for an example, investment A made $50,000 this year. Fantastic. Investment B was down by $50,000. You'll have to pay tax on the gain from investment A, but if you sell investment B, you can apply that loss to your taxes and reduce your overall amount owing. And this might not be a one-to-one trade-off. It does depend on the type of investment, but you get the idea. If you can't use a loss in this tax year, you can either carry it back 3 years or carry it forward as far as necessary to offset any capital gains. And if you have an investment that didn't do so well and you want the loss to be available for 2023 taxes, or you want to pull it back as far as 2020, you must sell it in 2023. So December 30th and 31st fall on a weekend this year. So you'll have to make sure that any trade is set for no later than December the 27th to make sure that everything settles in 2023. Don't leave it to the last second. Now, if you had a loss and you want to use it, but you still like the investment itself, you can repurchase that same investment, but you must wait at least 30 days to avoid the superficial loss rules. If you repurchase investments within 30 days, your loss will be denied. People try to play games with CRA, but CRA does not play. For instance, don't try to transfer an investment with a loss over to your RRSP or TFSA to realize the loss without actually selling the investment. That is a no-no under tax rules. And if you try to swap an investment from a non-registered account to a registered account, that can also get you some pretty heavy penalties. So don't do that. One way to avoid these problems, you could sell the investment with the loss inside of your non-registered account. And if you have the contribution room, take the cash from that investment, make that contribution into your RRSP or TFSA, and then the RRSP or TFSA can buy back the investment after that 30-day superficial loss period.